Massive amounts of corporate debt hitting the markets, private payroll out this morning, it's not looking very good. And then we have another oil tanker stricken by somebody, and the Houthis are claiming that. So that's the news we got for today, folks. So as you know, oil up, inflation up, that means these things are most likely going to go up today as well. So that's what we're going to talk about in today's show. My name is Dan Freer, I'm the host of the Rate Updates. My goal each day is to help explain to you homeowners out there, you home buyers, your realtors out there, what is going to go on with mortgage rates today. And the most important thing is the whys behind it. What I want to talk about it today is the first thing we got is private payrolls. They just came in this morning from ADP. They've been pretty darn good lately. 44,000 jobs created. That's dismal. We need 100,000 for kind of net neutral. So I'm saying this isn't a very good jobs report today. So that's going to put some pressure on the Fed because one of their mandates is to make sure the jobs market stays steady. Oil prices move higher after Yemen's Iran-backed Houthis claim Saudi tanker strikes. So I always say as oil goes up, inflation goes up, and that means mortgage rates are going to go up. So as a mortgage advisor, here's what I do each day. I look at this data and I say, okay, what's the bond market doing? Okay, so this is what I follow each day to figure out what mortgage rates are going to do. Okay, that thing right up through there says MBS. That is a mortgage-backed security, and that's going to be important in our next clip here. But all you have to understand is that number up through there. Okay, if it's red, that's not good news. It means mortgage rates are going to go up. The bigger the number, well, the bigger the adjustment. So 6 isn't really going to do anything. But let's get over to this piece of the puzzle. Here's what the Federal Reserve looks at. Here's what the markets look at to figure out, okay, how's the economy going? Okay, so the Federal Reserve controls that rate over there. It's the federal funds rate. If you're one bank and you need money, you can go to another bank and they'll lend it to you at that rate. We don't get those rates. But as those rates go up that the Federal Reserve controls, that means interbank lending goes up. So they're like, okay, we're going to push up the same cost to you, the consumer. So that's how that works. So they look at inflation, they look at the jobs numbers, and they look at GDP. Let's kind of go backwards. Secretary Bessent came in this morning, and he said the GDP for this year should come in probably about 3%. That is fantastic. We're 1.5 now. Anything above 0 is good. Okay, so that's pretty good. The jobs report, this has been staying pretty much on par lately. But today's numbers are cracking this a little bit. So this Fed, the mandate is to keep this pretty much where it is. But it's that pesky inflation over there. Okay, so what we've been saying, though, is the inflation is really due to oil and the energy market. So we've proven that. But now I keep coming back and people keep asking, so why aren't mortgage rates coming down? So if you look at mainstream media, and I'm going to show you here the data behind it, is there is a massive amount of debt hitting the markets. So remember when I showed you this chart right here and I said that's an MBS up there? Well, let's get over to see how the markets are absorbing this debt that we have right now. So this is basically the numbers of where we had in Treasury debt. That's Treasury is when the government runs out of money, well, they don't use a credit card. They issue Treasury bills and bonds, and that's how much Treasury we have outstanding. I'll get to that in a second. Then you have corporate bonds. The corporate bonds are all those AI build-outs right now. Okay, so that's a huge piece of this puzzle right now. Then you got the MBS. Sound familiar? Those are the mortgage bonds. And then you have municipalities. That's your state and local governments. If you look at these, they're pretty steady. Let's look at what stands out. You look at the Treasury. Now, the worst time I think we've had in decades is COVID, where we knew the government came out and stimulated the economy, and they pumped out $5.1 trillion in debt because they don't have any money. You got to realize that. So they have to put it on their credit card, which are these treasuries. Okay, so since then, they kind of curved and went back to normal times, 3 trillion, 3 trillion, 3 trillion. 2024, uptick some, the 4 trillion. We're at 5.2 trillion. We're exceeding what they did in COVID. That's not good news. Well, it keeps going. Corporate bonds, where are we now? Oh, look at the numbers backwards again. Normal times, 1.4, 1.4, 2. We're at 2.4. It exceeds anything in the last probably decade. So this massive amount of debt is what's really controlling the markets. Let me show you how this works. Okay, so let's say you're over here and you're trying to buy one of these bonds. So now you have Treasury bonds that you know the government's going to pay you, so there's 0 chance of default. Okay, that's a good investment. Well, the rates right now, let's say, are 4%. Okay, that's why mortgage rates aren't 4%. But let's keep going on. You have corporate debt. You have Google. You have all these companies out here. You know that they're going to pay their debt, but they need more money for this AI build out. So they're actually competing in this bond market. So you can buy treasuries at a 4% yield. Then you can buy these corporate bonds. It depends on how, healthy that corporation is. The healthier, well, the better the rate they're going to be able to give you, because they're going to pay you back, like treasuries. But the more leery you are on that company, then the higher yield you're going to want. So you have all that debt hitting the markets, and then you have mortgage rates hitting the market. So you have all that to compete with. So bond vigilantes, what they call it, they're sitting here saying, we're just going to keep buying, manipulating the market and keep pushing everything up and up and up. When's it going to be over? Don't know. And that's what we've got to follow. So do me a favor, follow two things, because so far you can see the trend. Oil prices up, inflation up, interest rates up. So watch oil and watch my channel. Subscribe over there every day for about 5 minutes. I'm going to give you all the details you really need to know on what's going on with mortgage rates for that day and then for the next few days. So let's get over to the rest of this piece of the puzzle. So you have this massive amount of debt hitting the markets. The MBSs are basically same on track, basically where they've been. Municipalities, the same thing. So that's where you're seeing it right through here. So let's get over to see where oil's doing for the day, because I say oil up, inflation up, all that stuff. Oil's up. The big thing right now is, I think the S&P earnings, I was just watching it, the average earnings right now are up like 30%. So, a little bit of an uptick in oil is really not going to do anything. This surprised me this morning, but you go to the pre-markets and you're up again. You got the Dow Jones at a record high. Now remember, all the crasher people, right at the wartime, this thing was 50,000. They were having the hats and celebrating. It was 50,000. It's almost 55,000 now. So hopefully you're participating in some of these things. You're getting some money, but oil right now is kind of flat. Let's look at the economic calendar we have for today. Here's that jobs report from ADP. 95,000 was the last reading. That wasn't a good number. They thought it would go down, and it plunged. So this might tweak the Federal Reserve's decisions a little bit, because now they can say, okay, maybe the jobs market isn't as strong. Let me go over and explain to you guys what I'm helping my clients do or advise them right now. So if you're working with us, I'm going to lock you in right now. And the reason being is the Strait of Hormuz, another oil tanker strike, could send oil prices rallying up again and interest rates up again as well. So I don't want to put you through that. But if you're looking to build or buy down the road, watch those two things. Watch oil and watch me each day, because I'm going to explain to you kind of where mortgage rates are going to go and the whys behind it. But if you're a home owner right now, you married that house and you dated the rate, do me a favor. Let me help you track those rates and maybe even your payments. Plug in your mortgage information right up in there. It's Rate Watch 2.2. We're going to track your rates for you. Put in, okay, Dan, I'm at 7. Let me know when it's 5. We'll track it. I'll call you, text you, and email. We don't sell the data. What you could also do in there, you could put in how much of monthly savings you'd want. Or there's even calculators in there. If you have some equity, does it make sense to, refinance or anything else like that? But if you're watching this and you're like, Dan, okay, I got all these loan estimates. I don't really know what to do now. Okay, so here's what most people do. They're told to get 3, 4, 5 different quotes. Yeah, that was the old times. But you go to this bank and they pull your credit, get back with you the loan estimate. You go to that bank, they actually turn you down. You're like, what's going on? Then you get to this bank, they approve you, but the rates and the fees are crazy. So you're like, what do I do? Well, use me. Here's what I do. I'm licensed all throughout the whole country. We're set up with almost 40 different lenders. And here's the reason why. Maybe one company will turn you down. One company might have a better rate. One place might have better fees. I can do all these for you, because I'm going to search almost 40 different lenders with one credit pool and one application. So that's what we can help you with there. But let's go back and let's see what the Federal Reserve is supposed to do in 42 days, because this is important. I want to kind of take a snapshot of this, because I'm going to show you how this is going to move as each day goes by. So yesterday, I think we had yesterday we had about a 67% chance there was a Federal Reserve hike at the next meeting. There's now a 56% chance. But now if you look down through here, they're going to increase rates in 2027 again. And then at the end of 2027, they're going to cut rates. Folks, here's what's going to happen. In the next couple of weeks, we're going to get a lot more information about Iran, inflation, the jobs report. These numbers can completely move right over here within 2-3 days. My expectations are the Federal Reserve, I don't know what they're going to do at the next meeting or two, but as the Iranian conflict ends, this pendulum is going to swing right into this range right through here. That's the current federal funds rate. And the next move after that, once the Iranian war is over, are going to be rate cuts. So when's that going to be? follow my channel, and we can follow this together. So let's get back to the chart. We are at a minus 0.07. We were at a minus 0.08 prior to that. So the markets are taking this oil tanker strike in stride, and the payroll numbers also. So rates aren't really going to move today, folks. So if you're trying to check where rates are, go to my website as well. Right through here, the rate update, click mortgage rates, and it's going to give you our website right through here. You can go to the top 6 products we have right through there. This is for mostly home realtors and loan officers. It's going to give you all the top news events and pendulums, the bonds that really affect mortgage rates. It's going to give you the top news of the day, what that is doing for mortgage rates for the day, the trend. We just added in our most recent podcast and blog. And then if you go down here through the bottom, it'll give you the poly markets or predictions markets, or what the Federal Reserve is going to do at the next meeting. So I hope you enjoy all my videos, our website, and even our stand store that's down below. It has all our free calculators. So thanks for watching. God bless. Have a fantastic day, and I will see you back here tomorrow at the opening bell to show you guys what in the heck's going to go on with these. And the most important thing is the whys behind it. Thanks for watching. See you tomorrow. Bye-bye.